Hello, everyone. Welcome back to Crypto's News. It is Wallace and I here, ready to give you the deets on what is happening on the crypto streets, talking about what is happening and what you need to be on top of. So here we are post merge, and Wallace is pretty happy, right, Wallace? He's a little disappointed about the price action, but other than that, he says he stays optimistic that things are going to be quite good. I apologize for not doing a video yesterday. Some days it just feels like the apathy and anhedonia are really bad from I'm still kind of recovering from everything I've talked about that happened to me. So I apologize the days that I can't be here, or it just feels like it's almost too much to be here, but I do try to be here as much as possible, and I thank you so much for that patience and sticking with me. I'm going to try to get through today's video, and I want to thank Lee for his tip on PayPal. I noticed he didn't enter a note, but it's nice when you guys do tip through PayPal because you can write something personal there, and I do read those, and I always appreciate that. But yeah, thank you so much, Lee. We're gonna go ahead and just get into what's going on here. What's up, LOL Kark, Kevin? Thank you for joining me, guys. So what we got with the prices today is Ethereum has continued to kind of sell off throughout the day. It held up somewhat right after the merge, but then we've started getting some sort of sell-offs. Is it the miners? Is it the speculators? It could probably be some combination of that. I'm hearing that the miners only have about 250,000 ETH left in their balances. So that would be about 20 days worth of mining that they have left, although I doubt all that's going to be sold. That's pretty much where we're at with that. It's Ethereum, a situation where it's only down 3.2%, which isn't that grave when you're thinking about the stock market and some of the implications around some of the FedEx news that we're hearing today that is causing fear. Bitcoin managed to stay flat, although it's still under $20,000. The market cap for crypto did drop under $1 trillion, but it's basically at $1 trillion. It's just a reason for folks to write headlines. But yeah, it looks like Jim Cramer had been the one to shoot at the Achilles heels or slice the Achilles heel here of FedEx, because as you probably know, you generally want to do the opposite of whatever Jim Cramer is doing. He's notorious for saying something on Twitter and basically the opposite of that happens, whether it's related to crypto or otherwise. So it looks like back in June 29th, Jim Cramer had predicted that Federal Express will have a great year, and they're down 23.12%. Apparently, they're going to have to be shutting down a lot of their branches. They are going to, well, basically they're expecting a forecast of about half of the earnings that they were previously forecasting, and they're expecting less volume. So while you can see that numbers still stay elevated, that might be due to inflation. We're seeing climbing inflation still, no end in sight. It's a real question as to whether the Fed can really do anything at all about this runaway inflation. It might be, I think it was really well explained actually by Peter Schiff in his recent podcast. He was talking about how basically we need to see this interest rate level that the Fed is trying to get higher, jumping higher and over the inflation rate. It's nowhere near the inflation rate right now, which is still ahead of the Fed's rate. Until that happens, it really can't really be. We're still adding fuel to the fire, and we're continuing to inflate. So might not be an end in sight, but I imagine things would break before we get up to the 9% levels or whatever. Who knows what inflation could be at if it does continue to climb and it hasn't just stopped off, right? It was previously transitory, and now it's just not. Hey, what's up, Soda? Pothead, old timers, appreciate you guys. So as I mentioned, I didn't do a video yesterday, but the merge did go through without a hitch. Wow, these are really low gas prices. You know, the merge wasn't supposed to bring such low gas prices, but you know, I have not seen 5 Gwei ever, I think, since I've been doing this show. This is among the lowest that I've seen. Usually it's around 15 we've seen during the bear market, so not bad if you are trying to do some transactions right now. But yeah, so far everything has gone just fine. I really like what ultrasound.money has done with their website right now. You can actually simulate now what it would be like to supply for ETH if we had stayed on proof of work. So you can see there, we'd be up since the merge, up almost 21,000 ETH in addition to what existed and had been issued previously. But instead, we're only up 552 ETH. So a huge drop in reduction. Although you have folks like Arthur Hayes, BitMEX CEO, out there that are quite disappointed with the price action. But I think most people are expecting this wasn't going to cause the price to go up within days, or it could easily have been weeks, months, if not years before the impacts are really reflected in higher price levels. But yeah, I really like ultrasound.money. Check it out if you want to look at all sorts of metrics. They keep adding even more to the website. You can see what's going on with the burns per block, I believe. Yeah, right there, you can check per block. And all sorts of other data. So check that out if that's of value to you. And this is just a funny video that was going around on their Ether Mine subreddit, or Ether Mining subreddit, which is or really used to be where you used to go if you wanted to interact on Reddit with the Ethereum mining community. This video was posted by a miner commemorating the shutdown of his last rig. What's going on, Rudy? I think that was it. That's when he clicks it right there. That's a nice bagpipe. I imagine he must have taken some of his profits and used it for that bagpipe. But a fitting way to end things. It wasn't nasty, at least. Most upvoted post there on the Ether Mining subreddit. There was a little bit of contention, a little bit of disappointment from the Ethereum mining community, but it's resulted in a drop in in graphics card prices across the board as they're being sold off a lot. So if you've been trying to grab a gaming card, then now could be the time. So you're also seeing that consumption is really, really low for electricity for Ethereum, which could make it look good. I know some of the Bitcoin maximalists are quite upset, saying that, for example, this is an attack on Bitcoin, Ethereum moving to proof of stake, by the very nature that now it means that Ethereum folks can point at Bitcoin and say you should tax it, you should regulate it for the terrible things it's doing for the environment. But I mean, YouTube, take a look at how much annual energy consumption in terawatts a year YouTube is consuming. Look at gold mining, 240. Bitcoin is not even up to that level at only 200. Ethereum proof of work, it was quite up there, but not even as high as Bitcoin. Netflix, I'm surprised at a 94. This was posted by Loopify there on Twitter, by the way. It's making the round, so I had to share it with you guys. Shout out to Decentralized who also retweeted it, and that's how I found it. And gaming, you can see. I'm surprised it's not higher, frankly, to see gaming only at 34. And Ethereum proof of stake sitting at a measly 0.01. So it's not even a part of the conversation about what's going on with energy consumption from Ethereum at this time. All right. Everyone's getting into it. So all sorts of FUD right now going around. There was a Wall Street Journal article talking about, and I think it was really wrongly interpreted, talking about how Ethereum might be a security. And those are some comments from the head of the SEC that were made just yesterday. And the timing, coincidentally, was right after, like almost the same day as the merge, within the same 24 hours of the merge, suddenly some sort of FUD comment about Ethereum saying that Ethereum could be a security under the new staking model. But nowhere in those sorts of terms did the SEC chief, Gary Gensler, the chair, come out and say that. He said some other comments that were interpreted wrongly in the title and got mass shared and caused the beginning of the sell-off, I would say. And there was also this section here with a hearing where the Senator Toomey came out and questioned Gary Gensler even more. So let's take a look at that.
For a lot of projects, as you know, decentralization and centralization occurs on a continuum, really, I think. And you've acknowledged that there are tokens, plural, that are not securities. I think it's because of this centralization that you come to this conclusion. And my point is, it is not reasonable to fail to provide clarity, to provide the definition of exactly where on this continuum you have a sufficient common enterprise that it qualifies as a security and where you don't. You've said Bitcoin doesn't. Some of your colleagues have said Ethereum doesn't. But a reasonable developer who wants to comply with this doesn't know where that line is drawn.
So I think where we might have a difference is there are many factors, and so it's not one spectrum of centralization versus decentralization. What the Supreme Court, and I try to stick to, they're the Supreme Court, and there'll be debates about other laws. I try to stick to what they say, a common enterprise. I think about a group of individuals in the middle. That developer is in the middle, and the investing public's betting on them, counting on them, even if the token might be on 1,000 computers. That's not what the Supreme Court's looking at. It's not about the token being on 1,000 computers. It's just like a group of developers in the middle.
But if there is nobody controlling it in the middle, that's what we call decentralized, and that does happen.
Yeah, exactly. So I guess, see, that makes Ethereum look good, some of his comments, frankly, because you don't have just one group of developers. You have many multiple clients and groups and enterprise, separate groups of developers. And there's not just one central foundation, for example, that's developing Ethereum at this time. So if anything, that makes Ethereum look quite good relative to some other projects that might be more centralized in some sort of aspects, such as development. And surely Gary Gensler understands that about Ethereum. So I don't know why everyone's picking on Ethereum. I think it's just because the merge just came out. But it just doesn't seem like a huge reason for FUD. But let's take a look at this thread, because I found this thread here by Adam Cochran, who took the time to write out, I think, one of the best arguments in favor of Ethereum not being a security, and taking a look at the Howie test and how something could be labeled a security, therefore fall under the purview of Gary Gensler and the SEC. So I think this is quite informative, and it should help you in your own future arguments and understanding about the overall situation, maybe even assuage some of your fears here. So I'm going to go ahead and take a look at this. Even though it's a little bit lengthy, it's really not too long, and I think it's helpful. So let's start at the top. I'll take the opposed in that I think there's a decent precedent to find ETH to not be a security, says Adam Cochran, in a post-merge environment. So again, this was written back in July July 24th of this year. This was just to get ahead of some of this FUD, or fear, uncertainty, and doubt around the merge that has now happened. So let's break down to some specifics. First, the Howie test prongs. We all know an investment of money, number one. Two, in a common enterprise. Three, an expectation of profit to be derived from the efforts of others. It's important to note that the Howie is a three-pronged test, but often misquoted as four prongs. Prong one is pretty clear. You must buy ETH to stake ETH, and even if we argue that it is putting ETH up as collateral rather than a purchase, there isn't a sound argument. In State versus Gopher Tire and Rubber Company, the court suggested that any risk capital that was the laying out of capital in a way intended to secure income or employment would fulfill this. And in Uselton versus Com Lovelace Freight Inc., the courts found that the investment of money can take the forms of goods or services or other exchange of value. And SEC versus Shavers, that was expressly intended to Bitcoin and other currencies. Where all this comes into question is in the some components of the second and third prongs of the Howie test, which are heavily debated parts of law with a number of differing tests in different courts, many of which have never ever been taken up by the Supreme Court of the United States. But let's first discuss the common enterprise. The term common enterprise is probably where the bulk of the litigation has taken place and where there are multiple schools of thought. Overall, there are tests of horizontal commonality, broad vertical commonality, and strict vertical commonality. We'll consider each of them in the framing of staking. In horizontal commonality, the courts look for elements of pro rata distribution of profits or the tying together of investor assets via the pooling of funds. Revac versus SEC Realty Corp. In cases like Hart versus Pooled Homes of Mission Corp. and Salser versus Merrill Lynch, Pierce, Fenner, and Smith Inc., the courts go as far as to say that the investment must be a part of a pooled group of funds. In Milneric versus MS Commodities Inc., it's noted that success or failure of other contracts must have a direct impact on the profitability of plaintiff's contract. When you run a validator node on Ethereum's proof of stake, your 32 ETH required to run that node are distinct and bound to your node. Your funds are not pooled. You receive rewards when the node you maintain perform its job, and you are slashed, lose some, when it fails. Your node succeeding or failing does not impact the interests of others, and so you'd be hard-pressed to argue that this measure of commonality is relevant. Now, in vertical commonality, the argument being made is that the relationship between the investors and the issuers is the relationship between the investors and the issuers or promoters. In this case, the argument is that you don't need to have earnings rise and fall together. Instead, your profits are tied inextricably to the efficacy of the promoter. SEC versus Glenn W. Turner Enters Inc. For example, in the Glenn Turner case, the company was paying participants to bring people to seminars in which Glenn Turner employees were closing the sale. Because the earnings of these participants were based on the efforts of the promoter and not on their own efforts, it was found to be a security. This was further refined in Villeneuve versus Advanced Bus Concepts Corporation, noting that the fortunes of the investors need to be linked only to the efforts of the promoter, and Long versus Schultz Cattle Company, requiring that the fortunes of investors be tied to the fortunes of the promoter. The first challenge here would be establishing in any way that there is some greater promoter or issuer for Ethereum. Ethereum is a decentralized, open source project with thousands of developers worldwide. More importantly, those building and issuing the code for Ethereum, which notably is protected under free speech, are not actually those running the network. The issuance of the code is separate and distinct from its implementation. They also do not expressly, through their involvement in its creation, own part of the network in a manner in which their fortunes are inextricably tied to that of others. There's an argument to be had that there is a common enterprise among the validators running the network and a cooperative mechanic between validators validating a transaction, but those are distinct and post facto to the development of the network's code. The actual network. The next question becomes the expectation of profit from the efforts of others. In United States Housing versus Foreman, it is noted that the core of this is on a reasonable expectation of profits to be derived from the entrepreneurial or managerial efforts of others. In SEC versus Rubera and SEC versus RG Reynolds Enterprises, both in the Ninth Circuit, the decisions note that Howie is a three-pronged test. This means not only must we expect profit, but the profit we expect expect must be from the efforts of others and not our own efforts or goods. This is a nuanced and important distinction for the argument of staking, and it relies heavily once again on the proving of the common enterprise. For example, in U.S. versus Holtz-Clow, a case in which a multi-level marketing program called Sell America sold gold coin certificates, the court decided they could not find the program to be a common enterprise because the material effort required was on that of the seller. Because the participant was earning from their own efforts and not the efforts of other investors or of the promoter, the court could not determine that to be a security. This part of the Howie test raises the fundamental question of what are you being rewarded for? When a user stakes Ethereum to run a node, why do they get rewarded? They are not rewarded because Ethereum developers continue to develop, because the network could stop development entirely today and it will continue to be used and nodes would continue to profit. The ultimate arguments are twofold. One, you are rewarded for selling block space to a user. This argument could be more construed as a common enterprise, although once again, not from a promoter or issuer, as it is in partnership with validators that block space is formed. But that's not what validators are fundamentally doing. Instead, they are selling validation, or a reliable amount of distributed server capacity that is online often enough that can attest to the fact a transaction took place. Each validator is selling their uptime. They have to have those nodes up, and they get slashed if they don't for the time that they're offline. And we know this because a validator is slashed when its uptime or trust becomes deficient, and it is slashed on an individual level. If we're rewarded for its participation and slashed for its downtime only on reliability and uptime, so this must be what is for sale. And continuing on here. So the question becomes, then is the managerial effort of maintaining a server sufficient effort that we are being rewarded for our actions and not the actions of others? The SEC has indirectly already answered that for us. In SEC versus Omero Joshua Garza, the SEC charged Garza over his cloud mining companies where he sold hash share contracts. While there was a fraud component to this case, he was also charged with violating Section 5A of the Securities Law Act of 1933. In this case, the SEC viewed that owning and managing the Bitcoin mining rigs servers was the managerial effort, and that selling access to their future earnings was therefore a matter of selling securities. In that regard, there's a strong argument to be made that the entrepreneurial and managerial efforts, as well as the expertise to maintain reliable uptime on an Ethereum validator, constitutes a material effort and is what is being rewarded in the network. To recap, extremely hard to suggest there is an issuer or promoter on Ethereum. Staking does not have horizontal commonality in relation to profits. Staking does have some horizontal commonality in relation to other validators, but they are not an issuer or promoter. The horizontal commonality in efforts is negated by the fact that your rewards and losses are solely based on your own validator's performance and actions and can be taken to other validator networks. You are selling uptime and validation and not block space, as your validator could connect to another PoS network or fork with other validators and do the same action. Staking does not have strong vertical commonality with the issuer. There is only broad vertical commonality if you believe what is being sold is block space and that the block space is owned by developers who publish code but do not run the network. There is an expectation of profits. Those profits are only derived from your own ability to maintain a reliable validator. The maintenance of a machine performing network validation has been shown to be a key managerial effort in the past. At first brush, the idea of buy token, stake token, earn token can look like a security. I get that. But with a nuanced understanding of the operation of a proof of stake chain, I think it fails to be a security even in a generous reading of the Howie test. If the SEC were to argue that Ethereum is security, I personally don't see that view being made more likely by the switch to proof of stake, and I certainly don't think anyone has the grounds to state it as such definitively. Anyway, I'm not a lawyer. This is not legal advice. This is my own opinion on why I think a claim that PoS ETH is security just doesn't stand up. I think that was really well formed and instructive because it's really not that simple. And unfortunately, we do have many folks out there that do not really understand the nuances or even how the somewhat basics of how staking works and what validation is and how these rewards are generated. So Jake Chervinsky put this quite well. I'd say, he said today, I haven't, and he is a lawyer, I'd say I haven't heard a compelling argument as to why staking makes an asset more like a security under the Howie test. But actually, I haven't heard any argument at all. It's just something people will say without regard for either one, how staking works, or two, what the law is. The general idea seems to be if you squint hard enough, staking sort of looks like a dividend or interest, and some actual securities have those. So maybe staked assets are securities too. That's not how the law works. That just means holders of staked assets expect profit, which alone doesn't make an asset into a security. Expectation of profit is only one of four. So he said there are four Howie test prongs, which is how I'd always heard it, but not according to Adam, as we saw in the previous post. And likely is the least important expectation of profits for volatile assets. For example, non-stable coins. People hold all kinds of assets with an expectation of profit: gold, cars, watches, etc. In other words, expectation of profit is a feature of all investable commodities, not just securities. Whether a profit comes in the form of an increase in market price, a staking reward, or any other mechanism should make no difference to the securities analyst. Although there is a growing debate as to whether, for example, some other products like those issued by exchanges like CB ETH, Coinbase ETH, that you basically get when you take your ETH that is staked on Coinbase and you wrap it and you can take it into this more liquid IOU-like format that allows you to move it around, but basically staked ETH is stuck there and it's managed by Coinbase. Coinbase does operate that node or multiple nodes on behalf of stakers on that exchange, and this could apply to other exchanges as well. I'm just talking about Coinbase specifically. Scientist had this to say on ETH Finance. Coinbase is offering an investment product, CBETH, not ETH, where the value of the product is expected to go up due to the work of a third party and promises this yield to retail. That's a security proper IMO, and that's a good thing because it diversifies retail staking. So maybe if you reach CB ETH, could be a security because it relies on Coinbase managing that node, having that responsible uptime, and it creates some sort of center whereby you have a common enterprise, you have a single issuer, I guess you could call it, an expectation of profits in the forms of yields that could be managed. For example, you go to Coinbase and you see the rate that they're publishing, they take their fee for this. That might be a security, and that could be a problem in the future that might result in some sort of growing discount, disparity, for example, between CB ETH and ETH. So I didn't want to present that as a possible risk to CB ETH since I have talked about it in the past. But right now it's looking pretty damn good for ETH. Just saying. And I thought that was an interesting hot take here that was put up by PA7X1. He said this: hot take of the day, EIP 1559 Ethereum proposal, the one that burned the fees, started burning them fees, made ETH into a commodity. Before its introduction, ETH was a currency and behaved like a currency. Let me explain. Currencies are means of payment. They exchange hands as a medium of exchange. And I love you too, Andy PDX. And their only purpose is to serve as money. Currencies are not consumed when they exchange hands unless you are burning some dollar bills to film a rap video clip. Commodities, on the other hand, are basic goods that are used as inputs to make a product. A commodity is consumed, spent, sometimes burnt when used. What you are left with after consuming a commodity is an output or end product. Before the introduction of EIP 1559, ETH was never consumed. It only exchanged hands. In this form, ETH was used as a currency to pay miners to execute transactions. ETH was merely a medium of exchange, hence a currency. Notes, currencies are still under regulation and oversight of the CFTC, but I think it's fair to make a distinction between a currency and a commodity as they behave differently. EIP 1559 made ETH into a full-fledged commodity. This was not the intent of EIP 1559 per se, as it was introduced for crypto economic considerations such as improving the UX of the fee market and fixing some long-tail problems with issuance and network security, but it has a side effect that ETH now behaves like a commodity. EIP 1559 made the Ethereum virtual machine, the EVM, hungry. In order for the EVM to do its work, it needs to be fed. Like a cattle is fed corn, a commodity. A furnace is fed fuel, a commodity. A tree is fed with fertilizer, a commodity. Or a mathematician is fed with coffee, a commodity. The EVM is fed with ETH, and ETH gets used, consumed, spent, burnt. The metaphor that is commonly used is, in fact, to call ETH that is fed to the EVM gas a form of fuel and say that ETH is burnt. We could equally have called it food and say that the ETH is eaten. It's just a metaphor to codify succinctly what happens with the ETH the EVM uses as input to make an output. The creation of ETH through staking also closely follows the production of commodity. To produce a commodity, you should need some other commodities as input. Sometimes even the commodity you want to produce as its own input. Apply some process that someone may have laid out or discovered for you. Invest some capital in tooling and machinery and apply human labor to get the commodity you are looking to obtain. For example, to produce corn, you have to lock up some corn underground, fertilize the soil using another commodity, water the commodity, invest in some farm machinery, follow specific farming techniques and process that someone may have discovered for you, and crucially, involve your own labor to tend for it and make it into an adult corn from which you can extract some yield. Same idea goes for cattle, coffee, steel, fossil fuels. The process for creating ETH follows the above. You have to lock up some ETH, invest some capital in tooling and machinery, such as a PC, a router, UPS, the power supply, use some other commodities, energy, internet bandwidth, follow a specific process which was discovered by a bunch of researchers, and crucially involve your own labor and know how to tend for it and make it into ETH. This last part is crucial because if you don't do your work properly, you literally don't produce and you may even lose your initial investment. Like a farmer may lose its harvest if it doesn't care properly for it. Your production relies on your work. You need to maintain the PC available, secure, and updated. You need to monitor its status, apply upgrades, and fix it if something goes wrong, and sometimes do it at inconvenient hours of the day. This is work and it is not exactly trivial. Otherwise, professionals with this skill set, sysadmins, wouldn't be so sought after and well paid as they are. The aforementioned makes ETH not meet the criteria laid out by the Howie test as a production of ETH, which is your expectation of profit from a staking operation. It relies on your own hard work, TLDR. ETH is not a security, whatever the FUD flavor of the day is these days, as it does not meet the Howie test that determines what is a security. It also grows, smells, and tastes like corn. I mean a commodity, so it should be treated like a commodity from a regulatory point of view. A side note, I heard that Gary Gensler could take up to 10 years before issuing any sort of comprehensive regulation for cryptos. It's still right now, again, litigation through enforcement, going one by one and figuring things out instead of offering clear guidance so that developers can do their job properly and stakers can know what to do and whether they're complying with the law. For example, these exchanges that are listing things. Let's just get on it, Gary. People are beginning to get upset, and it looks like even at hearings you have Congress people getting upset. So it might just be time to do it. Geez, it's almost like he wanted to bring down the price for some sort of specific reason. Not that I think it's because of his comments exactly per se. There could have easily been a sell-off either way. If I expect my coins to go to zero, are they still a security? That's funny, Kirk. So we were expecting that there might be an Ethereum proof of work coin that would exist after the merge, but it turns out we got two different kinds of new tokens, I guess you could say. They're not both forks, but it's been an interesting development because now we have this new thing called ETH, the Ethereum fork token, which, by the way, you do not get if you hold Ethereum or held Ethereum through the merge, which to me is baffling. It's just a kind of hanger-on coin that was pushed by Poloniex, which apparently a major investor now is Justin's son of Tron, and he tried to basically hang on to this to issue out his token and to get it to grow popular. This new token, Ethereum Fair, not Ethereum Fun Fair. If you guys remember Fun Fair, oh, that one crashed and burned. It's very disappointing what happened with Funfair. I think it could have really been a really cool thing. Unfortunately, development just didn't go the right way. A bad leadership, I would say, and it's just a lot that went wrong with that. But anyway, this is Ethereum Fair, not Funfair. Announcement on the renaming of Ethereum fork token, says Poloniex Exchange. ETHW as ETF. Ethereum completed its hard fork upgrade, the merge, on September 15th, 2022. Based on the market situation, consensus of users and community. Right. Because I'm sure everyone was calling for this. Poloniex has decided to choose the fork chain Ethereum Fair ETF, which is supported by the community's majority and more POW computing power, as the main chain for ETHW tokens. Poloniex will support the other fork chains and tokens as well, according to the situation. So Poloniex renamed their ETHW market as Ethereum Fair ETF, baffling everyone. and resume the trading of ETF markets across certain pairs, such as against Tether or ETH. The trading history of ETH markets will be inherited by the corresponding ETF markets. Poloniex will also list other valid Ethereum fork tokens for trading in due course. So the official, unofficial ETH token that we had all been talking about before, I'm pretty sure that's what they're talking about, since I haven't heard about anything else besides that. The ETF token is yet to be enabled for deposit or withdrawal, but if you did have ETH on Poloniex, you were issued an airdrop, from my understanding at the time. You will have that available to you on Poloniex's ETF token. So it's really, really, well, this was not taken, by the way, well by Chandler Guo, who seemed to be the person leading up the other Ethereum fork. The one that actually forked out of Ethereum and gave assets, or held those Ethereum assets on behalf of those who held through the merge, as opposed to just saying, oh, a split happened. We're basically going to pretend that everyone who had ETH doesn't have any. But if you had certain tokens, you get these ETF tokens. But yeah, Chandler Guo said Poloniex make huge mistake in relation to changing that market to ETF rather than keeping it for ETHW. So the tokens that are receiving this, I don't know what you want to call it, airdrop distribution, is if you hold Bitcoin, if you hold Dogecoin, if you hold Ether Classic and Class ZZ. First time I've ever heard of that token. So very odd, just a very odd switch that came out of nowhere. It looks like this Ethereum Fair token was trading around $17, and ETHW was changing hands at $12 on Crypto Exchange FTX. But I understand that ETHW has continued to drop. Kraken was one of the exchanges, for example, that listed ETHW, not ETF as far as I know, but they did list ETHW, and you have to wait something like, was it 60,000 blocks for confirmation? It would basically take you 7 days or about a week before your deposit goes through. So if you're hoping to sell right away, Kraken might not be the right way to go about it. But if you are hoping to dump your fork tokens, what's up, Renee? Thank you for joining us, brother. So if you are hoping to dump your forked coins, you can go to the link down below in the description to the Cryptos News subreddit. And I did link there to this post here if you want to check that out for yourself. It goes into how some of the ways you can go ahead and dump these two different forks. So check that out for yourself. And it lists some of the exchanges that you can do that. For example, it even talks about how you can sell on Huobi without KYC, this ETF token. But if you want to sell with KYC and you're cool with that, you can go to gate.io. So different options there for you. I'm not going to go through that again, but check that out for yourself. The Craig Wright drama continues. I thought this was just a notable entry into what's going on with the hearing that's happening in relation to the defamation lawsuit between Hodlonaut and Craig Wright. But it looks like the reason that we're not having Craig Wright sign the keys is because he destroyed the hard drive that held the keys. He stomped on them. It looks like this week brought us a sterling entry into this genre. Wright's lawyers have said they will try to establish his identity as Satoshi without relying on his control of the private keys that would definitively prove it. By way of explanation, Wright claimed this week that he stomped on the hard drive containing the keys. This seems to supplant his earlier claim that the keys were stolen in an elaborate home invasion. So he's using all sorts of tactics and saying all sorts of things to try to get his way. For example, he's relying more and more on how he is autistic, potentially, to talk about some of his inconsistencies and so on. I guess he talked about his own binge drinking. But yeah, what a saga and what a drama. CoinDesk did an opinion piece. You can check it out for yourself, entitled Craig Wright's Abnormal Psychology. In the Hodlonaut trial, Wright's claims about his own state of mind are as bizarre as his claims about blockchain technology, but there's an all too rational explanation. So check that out for yourself if that's of interest and you want to continue to follow this. And again, we're entering into a new era right now. It's going to be interesting to see where crypto prices head. I do feel like a lot of the optimism we saw recently was because of the merge, but now we're past the merge, so we have to be looking forward. But things are still quite uncertain. We know fundamentally numbers should go up according to what's happened with the merge and supply drop. might drag the whole space up, might get to a flippening at some point. But in the near term, it can be very difficult to assess where things are at. And there's a legendary investor who also mirrored this, what I'm saying right now. So check out what he had to say. This is being shared right now, and I wanted to present it to you because he even has no clue what's going on.
And between the pandemic and the war and the crazy policy response in the United States and worldwide, this is the hardest environment I've ever encountered to try and have any confidence in a forecast 6 to 12 months ahead. There are brewing issues when you get the price of oil doing what it's doing historically, and when you get interest rates doing what they're doing historically, and it becomes a global phenomenon with tightening liquidity, and you've got war. The odds of a global recession and a change in the macroeconomy are about as high and as severe as I've seen them in decades.
Oh man, you guys make the chat so interesting. Thank you so much for joining me today and being a part of this. If you were part of the chat, I hope you can make it next time if you didn't have an opportunity. And I thank you so much for your continued support. Happy Friday, guys. Survived another week. That's something great. And I'll finish with our quote of the day by Cynthia Ozick. We often take for granted the very things that most deserve our gratitude. And you know, I always think about how, you know, when you're sitting there and you're on the toilet and it's a lot of pain and you're just dying and you're like, oh my God, this is the most painful thing in my life. How come I'm never thankful for when I don't feel this way, for when things are just at peace. I never thank my stomach and my intestines and everything, you know. Let's take a moment to thank those things that we take for granted as we head into this weekend. So thank you again, everyone. I love each and every one of you. And I always have you guys in my hearts and my thoughts. And I thank you so much for joining me. Take care, much love, and stay cryptic. Peace.